Good afternoon, everybody, and welcome to the first Service Department News webinar of the year, complete with some quite avant-garde new theme music there. I think that might grow on me, that one. Today, we are going to be discussing the investment landscape for the Service Department and extended stay sector. My name is George Sell. I'm Editor-in-Chief here at International Hospitality Media, and we are a publisher of online B2B news sites for the hospitality industry, and we also organise conferences and awards. Now, this Service Department News webinar series is sponsored by IMS, and if you'd like to find out more about them, you can see some contact details there. There is also some information in the chat on Zoom, and we're just going to watch a short video to find out more about our sponsor. Okay, thanks again to IMS for sponsoring, and if you'd like to get in touch with those guys, please use the contacts there in the chat. So today's webinar is going to last an hour. We're going to have around about 45 minutes of panel discussion, followed by some Q&A at the end. We'd like to make it as interactive as possible, so if you do have any questions, please drop them in the chat or the Q&A on Zoom, and we'll try to get around to answering as many of those as we can towards the end. And a recording of the session will be sent to everyone who's registered via email. So I just wanted to have a look at, to give the conversation some context, some stories that we've run on our Service Department News website in the last few months. These are all fairly recent, and some of them actually include people we've got on the panel today. So you can see over in the US, we've had some of the big guns of investment, Blackstone and Starwood Capital there, making major plays in the extended stay hotel space. On the operator side, Numa has raised quite a significant funding round, and Philip from Numa is with us on the panel. And on the next slide, we've got some single asset acquisitions. Eden has recently acquired a hotel in Zurich for conversion to a Lock Apart hotel. Pandox has bought the Adagio Apart hotel in Edinburgh. And we've also seen some significant investments into operators, with Fortress acquiring a majority stake in the Prem Group. If you'd like to read these stories in depth, then the links to them are in the chat. So we've got a fantastic panel joining us today. I'm going to ask them all to introduce themselves one by one before we get into the meat and drink of it. So let's go from left to right as we see them. So Saar, good afternoon to you.
Afternoon, George. Absolute pleasure to sit here with this wonderful group of people. Many of them I know and worked with in the past. I joined Colliers 6 months ago to develop and lead hotel capital markets. I have around 18 years of hotel experience, majority of which is in the transaction space. and in the UK and throughout Europe. We are focusing these days on three things really. One, all of them throughout the transaction space, and in the main, looking at selling hotels and service apartments, funding them, be that refinancing or as developments, as operating businesses or leased investments, and sometimes acquiring those businesses for clients.
Thanks, sir. Jacqueline, welcome to you.
Hi, thanks for having me. As background, I'm at Brookfield Asset Management. I've been at the company for 3 years and oversee Eden, which is our apart hotel service department, sort of owner, operator, and developer that hopefully you're familiar with, but operates under the brands Lock, Cove, and Seiko. I'm in the portfolio management team, so I work with Eden across add-on acquisitions, financings, developments, sort of overseeing, I guess, all parts of the business that really require equity. And alongside that, I also work on our retail platform here at Brookfield.
Thanks, Jacqueline. Andrew, welcome to you.
Thanks, George. Andrew Hunter. I look after the Frio Group's hotel transactions across Europe, part of which involved us taking a stake in an operating hotel operating company, Michels and Taylor. Prior to that, my introduction, I suppose, to the hotel and specifically the apart hotel world was the Adina business, where I came on board at the very beginning of that to build that business up across Europe to what is today about 18 or 19 hotels, 3,000 keys centered around Germany.
Thanks, Andrew. And Philip, good afternoon to you.
Hi, good afternoon, everybody. My name is Philip Roeder, Director of Real Estate at Numa. Numa, as you know, was founded in 2019. We're a service apartment operator with over 2,000 unit strong portfolio. As of today, we're a very tech-focused company, so 90% of our guest journey, guest experience is centered around tech and fully tech-enabled. And as you saw, we just raised $45 million to continue on the growth and the path that we're taking. Before I joined Numa, end of last year, I spent 11 years at a German European private equity fund as the director of investment for the micro living strategy. So I have been within the alternative living segment, PBSA, service apartment, micro apartments, for a good 6 years at this point.
Thanks, Philip. And finally, Jacob, welcome to you.
Thank you. I'm Jake. I'm with Pandox. I work with transactions for Pandox. Pandox is listed hotel property company out of Stockholm. Currently, we have 157 hotels, predominantly the northern part of Europe, including UK and Ireland, Benelux, Germany, and Scandinavia. Majority is under variable lease contracts, but we also have our operating leg where we run about 20 hotels ourselves, cooperate with about 20 to 25 brands. And we recently acquired that Diageo in Edinburgh, our sort of first push into apart hotel segment.
Thanks, Jake. The LinkedIn profiles for all our panelists should be in the chat. So if you want to carry on the conversation with them after the session, then please do make contact via LinkedIn. So let's kick off by trying to get a broad brush picture about investor sentiment towards the service department and extended stay space, and perhaps how the pandemic has affected its appeal. Sar, do you want to kick off and just tell us, give us a general idea of how the investors you're talking to are viewing this asset class?
Thank you. Yeah, absolutely. So let's look first at 2021 as a year, at least in terms of the UK. We recorded around 4.3 billion pounds of transactions, which if you take the last 10 years on average and you you average it out, is about an average year. So surprisingly enough, in one of the most difficult years we've ever seen, and I've been around to see, you know, post 9/11, post the last recession and so on. This is, you know, the worst we probably have seen was 2020 with 1.8 or so billion, of which 1.5 were recorded in the first 3 months of the year. So just to give it a flavor, the last 9 months of 2020 recorded around 300 million of transactions. It's unprecedented. And so last year was, as an industry, okay. We talk regularly with investors, and it's a cross section of investors. And the sentiment is about the same, weirdly enough, if you talk to a very large investment company or a family office, or, you know, a lender for that matter. The least exposure to employment, to value chain or supply chain issues, the better. If you are in a self-sufficient environment, or at least have those provisions in the room, fantastic. If you have a C1 for that as a planning, or planning as a hotel, if you like, and not operating an operating business out of a C3 kind of permission, fantastic. And it's fair to say that even institutions that are now tiptoeing around or dipping their toes in the operational real estate are looking at service departments and budget hotels first before they look at anything and everything. Under the very, very strong and very right assumption, I think, that they'll be able to operate that with limited number of people, not be exposed to payroll issues, to supply chain, and be fairly COVID resistant. And I think we've seen better performance on the whole from service departments throughout the pandemic as well.
Yeah, thanks, sir. Jacqueline, Brookfield was obviously quite keen on the sector before the pandemic, but have the events of the last couple of years or so increased your appetite for the sector?
Yeah, I'd definitely say so. I think we acquired the Eden platform back in beginning of 2018, and really, I think what the pandemic has done, aside from its, you know, the obviously very negative impacts across the whole hospitality industry, is that it has sort of underpinned and validated, I think, some of the reasons why we invested in this platform to begin with. And I think there are sort of 4 reasons for that, some of which were already touched on. But the first one is the product type, the fact that it's sort of self-contained, autonomous units, which in you know, during a lockdown environment have been very you know, been a very popular product type, and worked very well when things like restaurant facilities and so on have been shut. I guess secondly, the lower cost base point around sort of supply side issues, and in an inflationary environment, that's definitely been favourable, higher margins than your typical you know, hotel model. Thirdly, the ability to be able to flex across a lot of different lengths of stay. So we took a lot of very you know, very extended stay demand, you know, almost kind of resi-like demand during the pandemic. And I think the ability to appeal to different segments and to sort of flex between them in different market environments has been really helpful for us. And then fourthly, I guess linked to that is having greater visibility over our cash flows, which again comes with having a slightly longer length of stay, slightly more predictability in terms of when you've got guests staying in the assets and so on, has also just really helped us from an investor perspective be able to you know, forecast the cash flows that we need you know, to go into the business or whatever, and to be able to get very good visibility over what the income stream is going to look like over the near term. So yeah, you know, it's definitely a sector that we're pleased we invested in. We will continue to invest in, and you know, the last 12 months or so have continued to be pretty active building out the platform across Europe.
Yeah, thanks, Jacqueline. Jake, you mentioned that you've just made your first steps into the apart hotel space. Was that prompted by the performance of the sector through the pandemic, or do you think you would have gone into the space eventually anyway?
I think we would have gone into it anyway, because we don't want to, I guess, make long-term decisions based on short-term trends. We started looking at this segment 2015, but then we started looking at it from a room category type when we took over a hotel in Kista in Stockholm. The surrounding areas of Kista is the sort of commercial demand is startups, internet companies, and when asking the guests, we understood that they're staying a longer time than normal hotels, and that they wanted those type of facilities. So we added a room category was long stay, and that was sort of the first taste of I guess this type of product Pandox took. And then we've also seen it again from a product perspective to see the type of a product that combines service departments, Airbnb, and hotels. So we've been keen on this segment since 2015, but we've been busy buying hotels. But we see this as a product diversification, but as part of sort of our industry, and that's hotels. That's what we know, the operational, the complexity of it, and it's sort of it's a fairly natural move for us to move from. We do have independent hotels, own operations, and moving that from there into this segment makes sense. Edinburgh has been a prioritized market for us. We've been looking for deals there, and the deal was a turnover-based lease contract. So yeah, we've been looking for this segment for quite some time, and hopefully to continue looking at the segment. Yeah.
Thanks, Jake. Andrew, Jacqueline and Jake have touched on some of the issues I think you'll probably bring up here, but how would you summarize the main advantages and disadvantages of the service department sector from an investor's perspective?
Okay, so I suppose there's the kind of things I've talked about, which is the lighter touch with staffing and so on. To my mind, the service department sector actually needs to potentially differentiate itself, particularly at the moment, a little more from the pure hotel sector. Let's be blunt, hotels for investors at the moment, despite what SaaS says about the volume of trade last year, is not the flavor of the month for institutional investors. I think there's a lot of people who just say, well, give me the data. Every single piece of data that's come out since March 2020 has been rubbish from anybody, and it's nobody's fault. It's impossible to say how this pandemic's going to play out, and I think a lot of people are very scared about that. The ones that have invested successfully, I think, are those with very clear strategies about, be it aggregation, turnaround, rebranding, reworking assets. But I think there's been some probably poor transactions as well over the last well, maybe 18 months, where we simply didn't get the forward projections right. And I think the opportunity for service departments is to say, well, look, we can operate differently from a normal type of hotel. And I think that we have a broader potential than's currently even being exploited. And I'll use a simple example, and it's just one example, but I was talking to, I'm not sure if everyone really knows, the FTC, Fosun Thomas Cook, the Casa Cook and Cook's Club and so on brands they have. And they've actually got an extended stay brand that is a pure extended stay leisure brand. It doesn't currently exist in Europe, but it's in Asia, and it does very well. And I kind of was really confused about this, and Tiago explained it all to me. And really it's all about people staying for longer in leisure destinations, but also the what do we call them, the working nomad, people who go and write a book somewhere. They don't want to do it in their apartment in the in the back end of a London flat. They want to go and sit in a nice spot and do it. And I think there's a lot of markets here that service apartments can access that we probably don't do yet, and we probably don't differentiate service apartments from the pure hotel market as much as we could, although I equally understand that there's reasons why it is always going to be very, very well compared, but also we've probably done ourselves a slight disservice in some of the way that we've evolved the product to become more hotel-like rather than less hotel-like. I'm not sure that actually answered your question, but
well, we'll move on to product type in a minute. But first, you mentioned brands there. It's fair to say the hotel space has become something of a brand fest. I mean, the major hotel groups have got enormous numbers of brands. The traditional service department sector for long-term business travel, a lot of it was pretty much unbranded. But Philip, do you think brands are becoming more important in this space?
Let me just quickly jump onto something that Andrew said before, because I think that's one of the key points. I mean, I did my first service apartment investment back in 2016. And ultimately, if you look at the strategy behind service apartments and the rationale behind service apartments, I think up until the pandemic, it was all very theoretical, because we've never been in a situation where certain demand channels have dried up to a certain degree or to a very extensive degree, depending on the jurisdictions and where everybody is in the wave. And I think what service apartments have demonstrated during the pandemic is, from an investor point of view, you always look at absolute returns and relative returns. And one of those key factors is obviously volatility, and how a certain product type responds to extensive shocks, external shocks. And I think what service apartments have demonstrated during this pandemic is, as an asset class, albeit it being fairly young from an institutional investor point of view, and also if you look at global transaction volumes, hospitality as a whole and hotels, the largest player in that, they will probably take their prime position back once the pandemic has come to an end. But I think this really has been the proof of concept in terms of A, it's a more versatile product. B, we can work with very different demand channels and demand characteristics in the market itself. And secondly, also, and I think this is also something Andrew mentioned, a few years ago, we're talking about how do service apartments, apart hotels, how do they address some of the mega trends, which is business, leisure, travel, extended stay. And I think this has all been ultimately fast forwarded during the pandemic, because now we live in a world where people don't need to go to the office. I haven't been in an office in almost 2 years on a regular basis, and it almost feels quite scary to do that again one day. And I haven't worn a suit in a long time, because it's just the new world we live in, and service apartments are an adequate answer to that question. In terms of the branding side, I think ultimately in an operating business, and service apartments more so than, for example, student housing or micro apartments are operating businesses, because the fluctuation is just a lot higher, and attracting new customers is one of the key aspects of our business. And also, I think the question of retention rates are more important than in some of the other alternative living segments. So I think brand it does play a large factor, and ultimately, I think it comes down to ultimate size. If you look at the big hospitality companies, the Hiltons and the Accors of the world, they have their brand recognition not just because they're good at what they're doing, but also because they have a certain size. And with size, obviously, comes the ability to play different fields in the market, play different segments in the market. I mean, I think we're yet to see a service apartment operator who has luxury brands, mid-market brands, budget brands, simply because there isn't anybody big enough as of today. So I think brand on an operational level is extremely important. We spend a lot of time and ultimately also money on building up retention rates, because it has a direct impact on our net operating performance, and that obviously translates into a direct impact on our investors' net operating performance for the buildings. But ultimately, on a large scale, I think it's a question of growing the market, growing the brands. And ultimately, during the pandemic, there is and has always been, a certain amount of correction in the market. So some brands, some operators did better than others, and I think this will also facilitate and progress the question of brand transition into the different segments.
Thanks, Philip. Jacqueline, could you talk us through your brand strategy briefly at Brookfield? You mentioned you've got 3 brands under the Eden umbrella. How do you differentiate them, and do you think there is room for more brands in your portfolio?
Yeah, so I guess the historical reason why we have the brands that we do is when we acquired the business back in 2018, we acquired 2 businesses essentially. So we acquired Seiko, which was the original sort of service department business, and then at the same time we acquired Lock, which is the kind of more lifestyle branded apart hotels, and we see them as very much 2 separate products and 2 separate brands that operate quite differently, but obviously with one overarching operational structure and kind of similarities in terms of the tech used and so on. But very broadly, Lock is, as I mentioned, lifestyle apart hotels. So slightly smaller room sizes, but more facilities in terms of F&B and gyms and meeting rooms and so on, and sort of operates like a quasi hotel in that sense, very inner city locations, drawing a lot of we have a lot of corporate contracts, things like that go into those assets. And then Seiko, which we have been rebranding as Cove, so they're very, very similar sort of product types. So those are very much service departments, so larger unit sizes, a bigger mix of sort of 1 and 2 beds, longer lengths of stay, and less, I guess, the very much less lifestyle focused. So it's a little bit more about consistency of product. You'll see that the room types are kind of much more similar across different assets than they are with Lock, where we have it's very much design led, a lot of variety and so on. Cove is a little bit more sort of repetitive / consistent in that sense, and there we're targeting a little bit more leisure locations, families, slightly lower ADR per square meter, although dependent on the room size. So there we see them as very much 2 distinct kind of approaches. And I think what we're very conscious of is while we don't want to have a huge proliferation of brands, we're definitely not thinking of rolling out another 2 or 3 over the next few years or anything like that. I think we are pretty clear in our minds in how those 2 different brands are differentiated. And then I guess following on from that, and to the point about sort of brand strength in general, I think what we're quite cognizant of is that as we've been expanding throughout Europe, we want to be quite flexible with our brand, and this particularly applies to Lock more so than Cove and Seiko, which is primarily UK based. But with Lock, I think what we've really tried to do is rather than having one set of very fixed designs that we roll out across different assets, we've tried to keep it interesting using different designers, having different styles, and then also flexing those designs to cater for the different markets that we're in. So that's partly regulatory in the sense that some markets, you do have different room sizes and different requirements for what you can provide, and then secondly, it's driven by the customer base that we think we'll get in specific markets. So I think, I guess in summary, I would say brand is really important to us, but we don't want to be kind of fixed into one specific mold. We think it's quite important, particularly within Europe and probably more so than in the US, for example, to be able to flex that according to where we are.
And what would be the average length of stay in Cove and Lock respectively, and how do you see that changing as things settle down, should we say, after the pandemic?
Yeah, I mean, it's very difficult to tell, and it's fluctuated a lot during COVID. So we had, you know, periods where there were more restrictions, where our length of stay increased quite a lot, and whereas then we went into a kind of a little bit more of a transient, you know, leisure demand-driven environment last year, where we had a much shorter length of stay on certain assets, particularly in regional UK. I think difficult to know how that's going to diverge going forward, but definitely as corporate demand tends to come back, I guess we expect to have our largest segment to be that kind of mid-stay sector, across both of the two brands.
Thanks, Jacqueline. Andrew, I can see you've raised your hand there. Do you want to come in on that one? And now you're on mute.
Sorry about that. Apologies. Yeah, look, I just wanted to pick up on the brand point. I think that serviced apartments at the moment are at a really interesting point, because we run the risk of actually resting on our laurels a little bit compared to other sectors. And I know we talk about, you know, so you mentioned it before, the efficiency and so on relative to other sectors. Well, I just give a couple of examples. I mean, I think the quality budget sector at the moment, the new players, and I know work as Motel One, obviously not that new any longer, Z Hotels in London, a couple of really good examples. These guys are every bit as efficient as pretty much all hotel operators. I don't think I mean, there'll be guys around the panel probably, and in the audience probably know far more depth than I do, but I don't think there's a significant difference in conversion to bottom line between most apart hotel operators and these budget brands. And the performance that they're driving is actually very good. Z Hotels were back up to about 86% occupancy for Q4 in London. I mean, that's astonishing. And that's really, I don't think there probably have been many apart hotels that would have done that. You know, Motel One's operation is so efficient. I think, and someone can correct me if I'm wrong here, but I think they could basically break even during the pandemic at around about mid-20s occupancy. Very, very well-run businesses. Now, we need to find something to compete against that. And I think there is obviously there's expense management and tech and so forth getting much better there, and that's one side of the balance sheet. But I also think the revenue side maybe needs to look at, and I'm surprised that there's not greater amalgamation of brands or absorption of smaller operators by the big brands to really create some power in the sector. I think what Brookfield have done is fantastic, and it's it's a great leap forward. But I think there needs to be more. I don't think there needs to be more. I'm sure there will be more, and I'm sure it will become necessary to actually drive. I think the sector is underbranded, I suppose, is what I'm saying at the moment. Yeah.
Thanks, Andrew. Sarah, from your point of view, what do you think we can expect in terms of consolidation and mergers and acquisitions? Can you see anything big on the horizon over the next year?
Yeah, I think we'll see more platforms being created and subsequently capitalize and grow. I think that branding is less conducive to that. I think it's more important to look at brands that are created as opposed to international brands represented in the hotel space. So if you look at the North American market in general, it's around 75% or so branded anyway, possibly 80%. Europe on the whole is probably the opposite of that, so around 30% branded. Of that, UK is probably, around the 65-70% branded these days anyway, compared to, so just trailing behind the US. And that is why it takes time for brands to go from the US into Europe. Europe needs to grow the traditional brands that were produced in the US, typically in the US, before new brands are introduced, including service departments. And to an extent, I agree with Andrew that some of the budget sector for some of the brands are in competition with the development of the service apartment and so on. But I think we'll see in terms of trading and consolidation, we'll see some in the operating space, much like Fortress have done with the Prem Group. I think what has happened with Eden is a great example to how one private equity takes a brand to a certain extent and then retains a development team, the creative team, going to a new venture and grows further. And we see the same trend with other platforms, Z Hotels being one of them, and so on. But I think we'll see more of that for sure. But I suspect it will be, not suspect, my view is that it will happen in the unbranded space and at the platform level, not for real estate owners that own a Staybridge Suites or a residence in for that matter. They have a place, you'll see portfolio transactions of that sort and so on. But I think the platforms will be more interesting. And I think as a last point on that, the biggest issue we see with service departments is the fragmented nature of the industry and scale. And when we talk about consolidation, if you buy one property, second property, you're not really consolidating. You're just acquisitive. It's when you create certain scale, and certainly when you get to creating your own brand, making your own impression on the guest experience, that you start looking like a platform as such. And I think that is one of the main barriers to entry for the bigger institutions, is that any service department deal that you look at looks from the outset increasingly small when you, for some of them, don't get out of bed for anything under 100 million deal. It makes that a very premature time to get into it as a sector.
Two of the brands.
It will happen.
Yeah. Two of the brands you mentioned there, Staybridge Suites and Residence Inn, are really the only two brands from the major hotel groups that have translated across to Europe from the States. We haven't seen.
Oh, I think Adagio. I think Adagio would beg the difference, but I agree with you. We haven't seen.
I was thinking about the US extended stay.
So Hyatt Place is starting to come on board. But I agree. We are in the UK and wider Europe. We are certainly behind the curve on that brand development. I don't particularly care. I think it's driven by guest experiences. It's driven by developers developing product, and it's driven by also to a certain extent accessibility to Airbnb and other formats of growth. So I don't. It's not our role in life to grow brands, be it American brands or European brands. It's their job to create an offering that works for investors, that work for lenders, and work for guests and customers. And so where that sort of holy trinity of development and hotel ownership and service department ownership come to a meeting of the mind, good things happen. If not, then they either don't happen or you have structural issues for some time.
Thanks, sir. Jake, the Edinburgh property you've acquired is your first. But do you think that this trend that we're seeing for smaller units and more communal space is one that Pandox will move further into with future acquisitions and potential new developments?
I guess the lack of the meeting space, having a more bed and breakfast kind of structure, is that what you mean here? Or
Yeah, I think, the apart hotel model in general is moving in that direction. The units themselves are generally getting smaller, but there's more in terms of F&B, co-working space, meeting space and stuff, but usually on the ground floor. Is that an interesting model for you?
Yeah, it is. The way we see it is it's going to be hard to have that type of product attractiveness by having two small units with kitchen and with sort of a pantry. So we're still in the belief that if we are to convert within our portfolio, I think we need a fairly good sized room for that. I do believe that there is a part of this sort of part of hotels that may move on more communal spaces, but that's I guess a thing that we've already seen in hotels with brands such as Hoxtons. You have sort of a great public areas, but maybe smaller rooms. So yeah, that could sort of move in, but yeah.
Okay, thanks, Jake.
If I may add, I mean, I think ultimately it's there's a reason why units have been getting smaller and smaller, and that's also in part, I mean, Jacqueline's fault, because obviously as we're getting more private equity institutional investors into the business, which is what we all want, because they can write the big checks and fund expansions, etc. These guys are obviously very return driven. Yeah, so the rationale behind smaller rooms is higher profitability margin. So the question is really, on the one hand, the financial one. On the other hand, it's obviously a part of, what is your brand strategy? What is it that you want to stand for? That you again focus on your customer retention. But I think ultimately, I believe the trend to smaller units will continue. I don't think there's one size fits all, because every brand does have a different strategy. But again, the reason why units are shrinking is because, with investors such as Brookfield, and you're obviously just one of all of them, who have the same methodology. You look at how can I optimize profitability, how can I optimize bottom line, and two small rooms are generally more profitable than one big room. That's the sad truth of it. And if you look at historic service apartments, I think most people today would argue that they're all too big. Funnily enough, when we did our first investments, I did my first investments 10 years ago in student housing, we concluded that no unit should be smaller than 25 square meters. Yeah, and I think anybody who does PBSA today would consider 25 square meters to be luxury, and people are going down to 19 and 18. So I think this is a trajectory which the market will take, also to be able to compete with what Andrew said. If you look at the most profitable hotel operators, they have a very standardized product. If you look at a Motel One floor plan, it's probably the least creative thing you've ever seen, because it's very simplistic, it's very straightforward. It basically comes out of a Henry Ford factory. Every room is the same, because it optimizes your workflow, it optimizes your FF&E, planning, budgeting, installations, and as the market continues to institutionalize and professionalize, this is something the service apartment players will have to adapt and adopt.
Philip, on the subject of optimizing profit, we have seen a few cases in the last year or so, both in the service department and the extended stay sector in the US, where we're seeing a deviation from the asset light model. We're seeing the OpCo and the PropCo under the same ownership. So obviously Blackstone and Starwood Cap have bought Extended Stay America, which owns most of its hotels. Brookfield and Eden being another case in point. We've seen APG invest in a couple of operating platforms, and they're going to own the assets that those operators have. Why do you think we're seeing a trend towards that in this space, when the hotel sector in general is still very much focused on the asset light model?
I think, and Jacqueline, correct me if I'm wrong, I think part of the reason is there's very little bespoke product. There's very little product today in the market, for example, that we could take over as existing operators. Yeah, I think one of the reasons why hotel brands and US brands have struggled expanding in Europe is simply because the way the market works. I mean, we're a large continent with a lot of small countries by their definition. That means that we have 25, 27 regulatory frameworks. We have 27 capitals. We have 27 different regimes on how to run this, how to license this, VAT implications, tax implications, trade tax implications. So it's a very, very complex, very, very fragmented market. The ability for an OpCo to attach yourself to a PropCo ultimately means I have somebody who can fund my expansion on the real estate. And the one thing that any service apartment operator will tell you is today, I think there's no lack of demand from a guest point of view. There's also no lack of demand from an institutional investor point of view, especially given the experience on volatility and resilience of the sector vis-a-vis the traditional hospitality market. The question is really how and who can fund the expansion for you. And if you obviously have an in-house, and I'm wording it slightly provocatively, somebody in-house who can write the big checks, like Jacqueline, that's obviously a very a pleasant thing to have. At the same time, it also takes away a bit your flexibility to do this with other people, because you're basically bound by one person's or one fund's investment criteria and whatever they perceive to be the market flavor. Whereas us, for example, we can work with anybody, and we do so very happily and successfully. And every investor has slightly different view on markets, return criteria, risk, etc. So there is a trade-off to both, but ultimately, I think we're still in a market where we need more real estate, a lot more real estate that we can play with. And fortunately, the likes of Jacqueline, Brookfield, and the others are enabling this for us to grow as a market, because ultimately the more successful Brookfield is, and I say this and I mean it truly, the better for us, because they're creating the blueprint, not just for our current investors, but also for our future investors.
Thanks, Philip. We've got some questions coming in. So before we get around to those, I just want to quickly talk about sustainability and ESG. ESG is obviously very high on investors' agendas now. Jacqueline, does this sector have any significant ESG benefits compared with other hospitality asset classes?
I think, I mean, ultimately, we're talking, it's hospitality, real estate, and I think the fundamentals are not that different. I think what we see as a benefit running a relatively small company, and that is expanding is there's an opportunity. We very much try and think about this sort of from day one. We're in the fortunate position that we don't already have a portfolio of 200 hotels that we're having to think about how we retrofit, and we don't have to change our mindset. It's a case of just as our mindset is forming, we can kind of integrate ESG criteria with that, and definitely in common with all of the sectors that we cover within real estate, we are trying to do that within the service department, the service department assets that we own, and that comes from everything to I guess like everyone, address the low-hanging fruit first. So we converted all of our UK assets run off sustainable energy. With the new builds, we always very focused on getting BREEAM certifications for those. And then one of the recent assets that we built in Cambridge, Turing Lock, was a little bit of a blueprint for us for how we should be doing this going forward. So there they integrated a lot of kind of modern technology around EV charging, air source heat pumps, things like that, to try and I guess be a little bit ahead of the curve rather than just being reactive. So yeah, yeah, I think I don't know whether it's a kind of service department versus hotel mentality, or more I think it's just a case of having a smaller company, a very young company that's growing and has a lot of energy to try and think about how we do things in a slightly different way. And I think that ESG considerations are all kind of part and parcel of that.
Mm-hmm. And the latest acquisition, the Zurich property, obviously repurposing a building has much less embodied carbon than a new build. Is that a route that you're taking more often?
I think it's something actually that gets really overlooked a lot of the time, because when you build a building from the ground up, you can do interesting kind of innovative things that are great to shout about, and actually I do think that's a point that gets overlooked a lot of the time, is that where you're repurposing, where you're using an existing building, the carbon footprint of that is significantly less. Like, being honest, it's not the reason for us acquiring this asset. It was a very good piece of real estate in central Zurich, but definitely I think that is a huge positive of it. It's probably, in general, it's obviously one of the challenges for service departments is that there aren't a lot of assets that you can convert, and I guess slightly contrary to Philip's point earlier, we don't always try and squeeze a service department in a hotel asset. We're very cognizant of the need to have a certain room size in order to get the length of stay that we really want to achieve, and that's challenging with the existing room stock that there is in these markets. So yeah, I hope that answers your question.
Thanks, Jacqueline. Okay, let's get around to some of the questions from our audience now. The first one here is from Lionel Benjamin, and he says, in the apart hotel market, is there room for the hybrid lease offering landlords rent and profit rent with capex and operations managed by the tenant? Who would like to have a go at that one? Sar, do you want to kick off with that one?
Yeah, and I think it's one for Jake and I guess we sold in Edinburgh the Adagio on a hybrid type lease where you have a turnover based and a minimum guarantee alongside with a little bit of retail, given the location of the asset. Whether it's done on the basis of a top line revenue with a minimum guarantee or a profit base top up, if you like, or rent, variable rent, it's less of an issue. I think where we would see a little bit more issue is with institutional investors, particularly. The more you look at profit-based rent, the more you have to manage or asset manage the entire P&L. Whereas with total revenue-based rent, all you need to do is have a quarterly certificate of what was the occupancy, the ADR, and the total revenue. And the rent is a derivative of that. So it's a little bit more intensive. It depends on the institution, the company that owns that. And I would say that if they own an operating business already, it shouldn't be a problem for them to operate any type of operating agreement or lease.
Yeah. Jake, would you like to add anything to that?
No, I agree with Sar, and for us, we're coming from the hotel industry into sort of hotel real estate into, I guess this is moved towards regular real estate. We don't mind operational risk. So us being owner of this type of hybrid leases, that's excellent according to us. But also we're willing to take on OpCo and PropCo in these kind of deals. So we approach apart hotel, this apart hotel segments quite similar to how we approach hotels. And the way we approach hotels would be franchise management contracts and leases. On the branding point, since it's a fairly fragmented brand landscape, for us then our brand maybe is a little bit more important than if it was a regular hotel.
Okay, thanks, Jake. David Wright has asked, how big do you feel a brand has to be for it to stand out as a brand, rather than just an operator with a few buildings in different locations? Andrew, do you want to have a stab at that one?
I'm not sure I'm qualified to answer that question, but I suppose what I feel is that actually as an industry, we do have something of a slight image crisis. Now, this might be perhaps a little bit harsh, but I feel that an apart hotel doesn't sound, a boutique hotel sounds wonderful. I'm not going to stay there. A designer hotel, brilliant. An apartment hotel, a service apartment, yeah, a bit boring. I'll take the kids there maybe. I think what we've done is, rather than tackling as an industry this problem, we've fallen into almost a trap of trying to emulate what hotels do and just trying to be a little bit more efficient. So we're getting smaller and smaller rooms until, frankly speaking, there's many apart hotels out there now whose rooms are smaller than other hotel brands. And my view is, I don't know how big a brand needs to be, but I think that big brands are probably the only way we can get around that problem, because the reason I feel it's an important problem to get around is because that's what's going to drive top line. And I think that's what, as an industry, we need to do.
Jacqueline, what's your perspective there? Because you, as you said, you started fairly small in terms of number of properties. What are your targets in terms of, you know, how big do you think the Lock portfolio and Cove, for example, can grow to ultimately?
So we don't have any specific figures on it. I think what the focus really is for us is that we want to be in all of the key European markets, and we want people, you know, if people are traveling for work or for leisure, to be able to, you know, go to these key cities and be able to pick out a Lock, or primarily a Lock, but potentially a Cove hotel there. So I think for us, it's less about the quantity of hotels in total, and more just about being in those specific markets. So we've just acquired an asset in Paris, which is our first asset there, which is you know, was a very much a key target location for us. We continue to be very focused on Germany. We have a few assets there, but you know, building that out a little bit more. There are still a number of German cities where we don't have a presence and are very keen to. And similarly in Southern Europe, where, you know, we do have a few assets, but we're very focused on you know, Madrid, other very key Southern European markets. So I think it's more about the breadth of coverage for us than necessarily the number of hotels we have in those locations.
Yeah, thanks, Jacqueline. And thank you all for your contributions. We've come pretty much to the end of the hour, which has gone very quickly. I'm just going to show a few more slides. The next Service Department News webinar is taking place on March the 24th, and it's called Taking a Bigger Slice of the Leisure Market. And you can see a QR code on your screen there. And if you scan the QR code, that will take you through to the registration page for the webinar. Alternatively, it's just been posted in the chat on our Zoom. Just wanted to quickly flag up an event that we're hosting in Paris on the 28th and the 29th of March called Recharge. It's at Stay City's Marne-la-Vallée property. More information in the chat. It's a great event. We move it around. It moves every year in different European cities. So we started in Amsterdam, we went to Berlin, we've been to Barcelona, and this year Paris. I've never been to another event like it. It's really good. I know I'm a bit biased, but it's a fantastic event. So I'd urge you to find out more about that. If you're interested in sponsoring any of our events or our webinars, please do give Katie a call. You can see her contact details on screen and also in the chat. And finally, thanks everybody for watching. Thanks to Saar, to Jacqueline, to Andrew, to Jacob and Philip for their fantastic contributions today. Thanks to IMS for sponsoring. As I say, we're going to leave the call open for a couple of minutes so you can take some notes. And I'll hopefully see you all on the 24th of March. Thanks very much.